Let's stick with technology and bring in Jared Weisfeld, a U.S. tech sector specialist for Jefferies. Jared, great to have you with us. Before we get to the specific quarters of Microsoft and Alphabet, I want to get your take overall on this market sell-off. The Nasdaq is at its lowest level since December of 2020. Is that where we should be, or do you think that there's more of a re-rating to come?
The headwinds that the market are facing right now are very significant, and I do think the decline is when you start, we were talking about on the show in terms of just the repricing of risk assets, and tech is the worst performing subsector within within the entire market right now, and specifically within TMT. Semiconductors have been leading us to the downside, right? We're all worried about a global cyclical slowdown. We see what's going on with the shape of the yield curves, and semis have been in a really rough spot. So, we're following semis from a price action standpoint. The world is slowing, and that's having its consequences. Right. So, tonight in particular, really rough night of results from Google and TI in particular. Microsoft, I agree with what everyone's been saying. I thought that was certainly the standout of the three that reported tonight. But I think quick answer to your question is, I think it's we're facing headwinds, and tech is certainly facing the brunt of it.
What was wrong with Google in your view?
So I think the big standout from a Google perspective was absolutely the deceleration in YouTube. Right. YouTube is now decelerating to only 14% growth year on year in the current quarter, and that's certainly impacted a little bit by FX headwinds. But we saw what happened to Netflix last week, right? In terms of there's just more competition for eyeballs on a 24-hour basis, right? And that's not specific to Netflix. You think about just the competitive landscape in the internet, and TikTok is gaining share across the board, right? To the point where even Google has introduced their own competitor to TikTok, and we're worried about TikTok competition for Google. We're worried about it for Facebook, and so I certainly think it's a combination of YouTube decelerating, and remember, Google is stepping up investments, right? They hired headcount. The headcount went up 17% year on year this quarter. So you have the deleveraging of the model with the revenue slowdown.
That's Karen. So just to expand on what you're just talking about, when you have the sort of read through of two negative things for Meta, which is the advertising more broadly, and then you have specific to YouTube, what do you think we're going to see from Meta? Is the bar low enough? It's actually down $7 after hours, but is it low enough or not?
I think we're going to see more of the same of what we saw from Snap, what we saw from Google, where the businesses started out the quarter pretty strong. Then we had the Russia-Ukraine conflict. We had the slowdown. And, when you think about Google and Facebook or Google and Meta relative to Snap, right, they've got twice the amount of EMEA exposure. So I'm expecting more of the same from Meta. Meta is further complicated by the fact that they've been impacted really significantly, not only by TikTok, like we've been talking about, but also from the Apple privacy changes that have really impacted the business. So I think all eyes are going to be on incremental commentary associated with whether or not they've been able to navigate those headwinds successfully, incrementally relative to last quarter. And then, of course, the build out of the metaverse, right? I think Meta is such a divisive stock right now from conversations that I have, just because Mark Zuckerberg is very adamant on building out the metaverse. He's changed the name of the company to it. He's spending $10 billion a year on Facebook Reality Labs. So I think the Meta story is a little bit more complicated relative to Google.
Jared, I'm trying to figure out what the impact of the supply chain issues are now at this point in time. Is it enough to say that China is locking down as much as it had in the early days of the pandemic, and so therefore the supply chain issues will be just as severe, and so maybe we're going to face them for the next year plus? Or have we learned a way to work around in any fashion so that the supply chain issues won't be as bad for technology?
It's probably, unfortunately, closer to the former. I think the companies that we're talking about here have done an amazing job in terms of navigating the headwinds, but we shouldn't think that the supply chain headwinds are behind us. I think Texas Instruments earnings are the best example of that. Right, they posted a very solid March quarter, but they talked about their June quarter guide being impacted by almost 1,000 basis points because of the lockdowns and the COVID-19 restrictions that are currently ongoing in China. So we're still dealing with complicated supply chain issues, and just given what's going on right now in China and Shanghai in particular, it continues to have significant implications across many of these companies, including a company as large as Texas Instruments. And I know Guy was talking about TI a few minutes ago. And I think the other thing to mention on TI is maybe there's a little bit of a silver lining here. This is the first quarter that they've bought back stock in a meaningful way in a long, long time. They repurchased almost $600 million of stock in the quarter versus about $100 million or so for the last year and a half or so. So, maybe we're getting closer to the bottom, and they certainly feel better about it, but maybe that's a silver lining.
All right, Jared, always great to get your thoughts. Thank you.
Thank you so much.
Jared Weisfeld. Not a pretty picture for technology, Steve Grasso. What are you thinking about in tomorrow's session and for the rest of the week as we continue to get more earnings?
Yeah, I think technology is obviously going to be under a tremendous weight until we actually see what the Fed does versus what the market has assumed the Fed is going to do. The Fed has no business in trying to talk themselves down into a more dovish fashion because they want the market to adjust to what's happening right now versus them having to do all the heavy lifting. But the other important thing is the neutral rate that everyone keeps talking about with the Fed. That is neither dovish or hawkish or a tailwind or a headwind to the overall market. If the Fed really wants to stop inflation, they have to go past neutral. So they have to push us into a recession. And if that's the case, then the market wants to go lower. So 4,000 might not be where it stopped because we were close enough to that just a handful of weeks ago. I think we could see an overshoot that everyone on this desk has seen in the market all the time. We could see a 38 handle in the S&P before all of this is done.